I think they are worried about it. I think they're worried about some elements of froth and frenzy all over markets, and this is just one other aspect of that. The problem is they can't really say they think that's a macro problem, because if they say they think it's a big problem, then the next obvious point is, well, are you going to pull back on all this liquidity, which is causing this problem? And they don't want to say that because they want to keep long rates low until the pandemic is over. So I think what they'll say is, yes, we're concerned about individual investors, and individual investors need to be we need to be careful here, but we don't think it's a macro threat. Now, whether they do think it's a macro threat or not is another matter, but I think the messaging will be it's not a macro threat. We're still low rates for a long time. That's our policy.
Yeah, Jim, I want to get your thoughts on this as well, because I think we can talk about what the Fed thinks versus what the Fed is going to say, but it definitely folds back into that story about easy monetary policy, making parts of this market look incredibly frothy right now.
Right. So what we have to understand is that the Fed's goal is to close the output gap as quickly as possible by keeping financial conditions easy. It's what they can do. Essentially, the output gap is really just a measure of excess capacity that's in the economy that was brought on from the shortfall in economic growth in 2020 due to the pandemic. So the idea is that we have to get growth to come back very, very quickly, and not just recover, but actually boom enough to close the output gap probably in the next couple of years. So we would need to see at least 5% growth this year and 5% growth next year on average in order to do that. So does that mean that there is excess liquidity in the market? Does that mean that there might be some frothiness? Yes. And I think that's going to be a residual side effect. But for the Fed, it's a cost-benefit analysis of saying, look, we can either pull back all this liquidity, as David Kelly was saying, which would be a mistake, or this is a regulatory matter for somebody else to handle. This isn't what the Fed does. The Fed doesn't worry about single-name stocks. What the Fed is, they're a macroprudential regulator.
Fair enough, but don't you think the Fed
system
watches the markets very closely? And when we see major moves in the markets, which when you're talking about things like, record leverage right now, record margins, it can exacerbate those moves, and it can actually spill over more broadly from a single stock to other parts of the market?
Yeah, certainly the level of interest rates is low, which makes leverage very, very cheap, which means that a lot of people end up taking on a lot of leverage. So therefore, speculation does tend to get very, very frothy. Absolutely, that point is taken. But I think the Fed has to understand, what their toolkit actually is. If they control interest rate policy and other macroprudential policy for the financial sector, this isn't something that they can directly address. This is something for regulators and other areas to do.
So okay, I get the notion. We've been talking about looser monetary policy for a while now, but the actions taken by the Fed are not necessarily just about the trillions awash in the marketplace. There were a number of emergency lending efforts undertaken, not just by the Treasury, but by the Fed as well. All of these policies were there to help save American businesses, right? And that's kind of what happened. GameStop, I'm not talking about the trading action right now, but it is a company that may have been impacted by the pandemic. And to a greater degree, many of these other restaurant-type companies out there may have been impacted as well. So isn't it better for the Fed to be as involved the way it is right now, for the Treasury to be as involved, Mona, the way that it is right now, because it is there to save jobs and keep businesses in business?
Yeah, absolutely. Look, I think the programs that were put in place to give small business loans, to provide the PPP support, are very much different and should be distinguished from what's happening with companies like GameStop, like AMC, which do happen to be companies that were hit hard in the pandemic, but now are going through a period of speculation. These are really being driven by speculative hedge fund type buyers, retail investors that are playing with long short money here. And so I think there's a different category that those stocks can be put in versus the broader economic recovery story, which we very much do think that the Fed and Janet Yellen now in the Treasury could work together and support more broadly. It's interesting to note also the market has been up since the March low. S&P has been up 65%, NASDAQ's been up 95%. There's a bit of emboldening going on here. The retail investor feels a little bit emboldened. They also may be looking for, investors broadly, where else can they get that type of return? And so you're seeing speculation ramp up, but should be very much separated from a broader economic recovery.
Shepard Smith here. Thanks for watching CNBC on YouTube.